Imagine this. PayPal stock, once a darling of Wall Street, soaring to incredible heights during the pandemic, and now sitting much lower than many investors expected. Some say it's a golden opportunity to buy at a discount, while others warn it could be a trap for anyone hoping for a quick profit. In today's video, we're going to cut through the noise and break down everything you need to know about PayPal stock in 2026, from its business model and revenue streams, to the reasons behind its recent slump, the opportunities it still has for growth, and the risks every investor needs to consider. By the end of this video, you'll have a clear picture of whether PayPal is worth buying now, holding for the long term, or avoiding altogether. We'll explore how PayPal makes its money through online payments, peer-to-peer transfers, merchant services, and emerging fintech products like Buy Now, Pay Later, why competition from giants like Apple Pay, Block, and Visa has been pressuring its growth, and what analysts are saying about its valuation today. I'll also give you a realistic look at the company's financial performance, revenue, profits, cash flow, and margins, so you understand the numbers behind the hype, and we'll cover the key opportunities that could drive its stock higher, from international expansion to new technology integrations, alongside the risks that could hold it back. So whether you're a beginner trying to understand what PayPal actually does, or a seasoned investor looking for the next potential big move, stay tuned, because this breakdown will give you the full story, no fluff, just everything you need to make an informed decision on PayPal stock today. What PayPal actually does. PayPal isn't just a company that lets you send money online, it's become one of the biggest digital payment platforms in the world, touching hundreds of millions of people every day. At its core, PayPal allows users to transfer money between individuals and businesses quickly, safely, and without the need for traditional banks. Imagine you want to pay a friend back for dinner or buy something online. Instead of using cash or a credit card, you can use PayPal in seconds. But it doesn't stop there. PayPal also provides merchant services, meaning businesses can accept payments from customers globally, whether it's through a website, an app, or even in physical stores. What makes PayPal special is how it makes money. Every time someone pays using PayPal for a business transaction, PayPal charges a small fee, often a percentage of the sale. On top of that, it earns revenue through currency conversions, interest on held funds, and new products like Venmo's peer-to-peer transactions and Buy Now, Pay Later services. Over the years, the company has also expanded into financial services, including digital wallets, cryptocurrency buying and selling, and working with merchants to offer smoother checkout experiences. For investors, understanding PayPal's business model is crucial because it's a company powered by transactions. The more people spend online, the more PayPal earns. And with e-commerce and digital payments continuing to grow globally, PayPal is positioned at the center of a huge financial ecosystem. But while the opportunity is massive, the company also faces stiff competition and pressure to innovate constantly, which we'll explore in later chapters. PayPal stock history. PayPal's stock history is a roller coaster that tells a story of growth, hype, and correction. After going public in 2002, PayPal quickly became the backbone of online payments, thanks in part to its early association with eBay. Investors loved it because it combined rapid growth with consistent profitability. Over the years, PayPal expanded internationally, added new services like Venmo, and became a household name in digital finance. The stock's real meteoric rise came during the pandemic, with lockdowns keeping people at home. Online shopping exploded, and PayPal's user base grew tremendously. The stock hit record highs as investors bet on long-term growth and digital payments becoming the standard. Many analysts called it a tech stock with a financial twist, combining the growth potential of Silicon Valley with the reliability of banking. However, no stock climbs forever. As economies reopened and growth expectations normalized, PayPal faced a reality check. Its stock price fell from the highs, partly because the company missed some revenue projections, and partly because investors began comparing it to new, faster-growing fintech rivals. This decline has sparked debate. Is PayPal simply correcting after a hype-driven surge, or does it reflect deeper issues in growth and strategy? To answer that, we need to understand why its stock dropped so sharply. Which brings us to the next chapter. Why PayPal stock dropped. Several factors contributed to the decline in PayPal stock. First, growth has slowed. After the pandemic surge, active users and transaction volume have not increased as fast as analysts expected, leading to disappointment in the market. Investors who were expecting a repeat of exponential growth saw the reality. PayPal is now a massive company, and sustaining triple-digit growth is challenging. Second, competition has intensified. Fintech players like Block Inc., traditional payment giants like Visa Inc., and tech companies like Apple Pay are aggressively innovating and capturing market share. Venmo, once a unique offering, now faces rivals that combine mobile banking, digital wallets, and instant payments, putting pressure on PayPal to innovate or lose relevance. Third, macroeconomic factors have played a role. Rising interest rates, inflation, and a slowdown in consumer spending have affected PayPal's transaction volume. Investors are also wary of tech stocks in general, which impacts PayPal even if the company's fundamentals remain solid. Finally, market sentiment matters. Stocks often move based on perception rather than fundamentals. PayPal is seen as a high-growth tech stock that is now transitioning into a more mature phase. This shift can spook growth-oriented investors, creating downward pressure on its stock price, even if the company's business remains strong. Understanding these reasons is key before considering any investment. PayPal financial performance. Numbers don't lie, and PayPal's financials tell a story of resilience and caution. The company has consistently generated revenue in the billions, driven by transaction fees, merchant services, and peer-to-peer payments. Even in periods of slower growth, PayPal remains profitable, with strong operating margins that reflect efficient management. Its cash flow is healthy, giving the company the flexibility to invest in new technologies, acquisitions, and expansion efforts. For investors, the revenue breakdown is important. PayPal earns money from three main segments: transaction fees from consumers and merchants, value-added services like currency conversion, and emerging products such as credit offerings and buy now, pay later. Each segment has potential for growth, but some, like credit services, carry additional risk due to economic conditions. One key indicator is user growth. PayPal's active accounts continue to expand globally, albeit at a slower rate than during the pandemic. Average revenue per user has also stabilized, showing the company is finding ways to monetize its base even when transaction volume growth slows. Analysts look at these numbers to gauge whether PayPal is undervalued relative to its potential. In short, PayPal's financial performance shows a profitable, well-managed company with strong fundamentals. But investors must weigh these numbers against competition, market conditions, and growth expectations to determine the real investment opportunity. PayPal growth opportunities. Despite challenges, PayPal has significant growth opportunities that could push its stock higher in the coming years. First, global digital payments are still on the rise. Countries with low banking penetration and high mobile usage represent a massive market where PayPal could expand its user base. International expansion could be a key driver for long-term revenue growth. Second, innovation in fintech is a major opportunity. PayPal is investing in products like buy now, pay later, crypto trading, and AI-driven fraud detection. These products not only attract new users but also increase engagement and revenue per user. Venmo, once a simple peer-to-peer app, is transforming into a full-fledged financial platform, competing with challenger banks and other fintech apps. Third, partnerships with businesses and e-commerce platforms offer growth potential. By integrating PayPal as a preferred payment solution on large marketplaces and apps, the company ensures a steady stream of transactions while creating lock-in with both consumers and merchants. Finally, acquisitions could accelerate growth. PayPal has historically bought smaller fintech companies to expand services, increase market share, and gain new technologies. With strong cash reserves, the company can continue this strategy, providing additional catalysts for stock growth. Risks of investing in PayPal. No investment is without risk, and PayPal is no exception. Competition is intense, and if the company fails to innovate or loses market share to rivals like Block, Apple Pay, or even emerging fintech startups, its growth could stall. Technology risks also exist. Security breaches, fraud, or regulatory changes could damage trust in the platform. Macro risks matter too. PayPal relies heavily on consumer spending and online transactions, which are sensitive to economic slowdowns, inflation, and interest rate hikes. Changes in global financial regulations could also impact international expansion, making growth slower than expected. Additionally, market sentiment can affect stock performance. Even if PayPal meets its earnings targets, investor perception of the stock as a slow-growth tech company could keep it undervalued. Understanding these risks helps investors make informed decisions rather than being swayed by hype. Is PayPal stock undervalued? The million-dollar question. Is PayPal undervalued today? Some analysts argue that the stock's current price reflects a discount after the post-pandemic pullback. Compared to other fintech and tech companies, PayPal trades at a reasonable price-to-earnings ratio, offering potential upside if growth rebounds. Others caution that PayPal is transitioning from a hyper-growth phase to a mature stage. While it remains profitable, revenue growth may never return to pandemic highs. Long-term investors must weigh its strong fundamentals and cash reserves against slower user growth and rising competition. The truth is, PayPal could go either way. If digital payments continue to grow and the company successfully innovates, investors could see substantial returns. But if competitors take market share or macroeconomic conditions worsen, the stock could stagnate or decline further. The key takeaway: PayPal is not a guaranteed winner. But for those who understand the risks and opportunities, it could be a valuable addition to a diversified portfolio. To conclude, PayPal's story is complex but fascinating, a blend of innovation, growth potential, competition, and caution. Whether you're bullish or bearish, having a clear picture of the company's business, numbers, and market environment is essential before making any investment decision. As we wrap up this deep dive into PayPal Holdings, the big question remains: what should investors actually do right now? PayPal is no longer the fast-rising growth stock it once was, but that doesn't mean its story is over. In many ways, the company is entering a new phase, one where stability, profitability, and long-term strategy may matter more than explosive growth. The digital payments industry is still expanding, online commerce continues to grow, and PayPal remains one of the most recognized and trusted platforms in the world. That kind of position doesn't disappear overnight. But at the same time, competition is fierce, innovation is constant, and the market can change quickly, which means investors need to stay informed and realistic about both the upside and the risks. The truth is, some investors believe PayPal could be one of the most undervalued fintech stocks today, while others think its best growth years are already behind it. And that's exactly what makes this stock so interesting. It sits right in the middle between opportunity and uncertainty. Whether PayPal turns into a long-term winner or continues to struggle will depend on how well the company adapts to new technologies, new competitors, and changing consumer habits over the next few years. Now, I want to hear from you. Do you think PayPal stock is a buy right now, or would you stay away? Comment below and let me know if you're bullish or bearish on PayPal. If you found this breakdown helpful and want more deep dive stock analysis like this, make sure to subscribe and turn on notifications so you don't miss the next video. And in the next episode, we'll analyze another major stock that could be massively undervalued right now. So stay tuned, because you won't want to miss it.